So let's look at other current liabilities. Now, other current liabilities are part of the other financial statement items that are required to be included within your financial model to ensure that your financial statements reconcile with your historical financial statement data. Now, when we first bring in your historical other current liabilities balances into your financial model via your accounting package, these are brought into the historical balance sheet and are located within the current liabilities section underneath your dividends payable. You can see here in this example, we have one category titled other current liabilities with the historical balances on the right hand side of the sheet. And if we then scroll across our time series until our last historical month of June 22, we can see that we have a historical closing balance of 11.4 for our other current liabilities. Now, when you forecast other current liabilities, this is handled on the other financial statement items sheet and is located below our other non-current assets analysis. We can see we have our one category of other current liabilities being brought through, as well as the historical balance of 11.4 from the historical balance sheet, with our driver currently set to an absolute change. Now, in an ideal world, other current liabilities should not be a major part of your current liabilities because major current liabilities items should have been accounted for within dedicated forecast accounts such as creditors or as custom line items. For this reason, other current liabilities are usually modeled quite generically, using an approach such as forecasting the movement in closing balances each period. In this example, we can see we have our balance of 11.4 remaining flat throughout our forecast periods. If we look at October 22 as an example, if we assume that our balance of other current liabilities increased by 5 within the period, if we input a forecast assumption of 5.0, we can then see our balance increases to 16.4, up from 11.4 within the October 22 month. Now, when we look at the financial statement impacts of other current liabilities within a full three-way financial model, it's important to note that movements in other current liabilities does not affect the net assets of a business. So for the balance sheet to balance, if we assume an increase in our other current liabilities balance, we must put through a positive adjustment to cash. By default, this is included in the cash payments within the operating section of our cash flow statement. This positive adjustment to cash increases our change in cash held and increases cash at bank, increasing total assets. The increase in total assets matches the increase in our other current liabilities balance, ensuring that there is no change in the net assets of the business. Now, looking back at our example, we can see in the October 22 month, we have a closing other current liabilities balance of 16.4, increasing from 11.4 in the month prior. This increase is matched with a positive adjustment to cash of 5.0 currently flowing through the cash payment section. Now, if we want to see these impacts within the financial statements of our model, we can head back to our table of contents and activate the financial statements. Firstly, looking at our balance sheet, we can see we have our other current liabilities balance, and if we expand this, we have our one category of other current liabilities. If we then scroll across our time series until our forecast month of October 22, we can see we have our closing balance of 16.4, increasing from 11.4 in the prior period. If we then scroll down to our cash flow statement and expand our cash payment section, we can see that we have our positive adjustment to cash of 5.0 in the October 22 period flowing through our cash payments to match the increase in our other current liabilities balance. So to recap, when looking at the financial statement impacts of other current liabilities within a three-way financial model, other current liabilities does not affect the net assets of a business. For this reason, if we have an increase in our other current liabilities within the current liabilities section of our balance sheet, we must match this with a positive adjustment to cash, which by default flows through our other cash payments within the operating section of our cash flow statement. This increase in cash matches the increase in our other current liabilities balance, ensuring that total assets and total liabilities increase by the same amount, and therefore there is no change on the net assets of a business.